Everyone, thanks for joining our webinar today. We're going to be talking about financial safety and control, and we have a lot of good content for you. So before we get started, I'd like to go through a couple of housekeeping items before we get into the content. You can maximize or minimize the webinar pane during the presentation by using the red, orange arrow buttons. During the webinar, we also encourage you to ask questions. In the webinar pane, you'll see a question box that you can use to type your questions in and click Submit. Our presenters will answer those questions as time allows during our Q&A session at the end of the presentation. Second, to ensure good audio quality, please check your settings to ensure that the appropriate audio option is selected. If you're using a telephone, please click on the phone call audio option. Or if you're listening through your computer, then please click on the computer audio option. Now, I'd like to present a quick review of our CPE credit requirement. In order to qualify for a CPE, you must use a personal computer, no smartphones, and log in with your own information and unique URL. Be logged into our online software for at least 50 consecutive minutes within the scheduled time frame for the webinar. Actively respond to at least 75% of the polling questions, and complete the evaluation survey at the end of the webinar. Also, please note, as a participant, you will receive a link to the download the slide deck and recorded presentation within 48 hours. And since we're a very digital world, make sure to follow us on social media. We'll be doing live tweets at Armenino LLP on our Twitter account. And you can also go to armeninolllb.com and follow us on any of those social media icons presented at the bottom of the webpage.
Right, and the hashtag for today is hashtag nonprofit fraud.
All right, so let me start off with introducing our presenters. We have Michael Bolton. He is a partner of our audit practice. And Mike has more than 10 years of experience in public accounting. He specializes in financial statement audits of non-profit organizations and private and publicly held middle market businesses. His nonprofit practice includes private education, foundations, and religious and performing arts organizations. In addition to financial statement audits, he assists companies with financial statement reviews, compilations, and general accounting consulting. We also have Eric Thomas, director of our outsourced finance and accounting team. Eric has over 15 years of experience in finance and accounting and joined the firm in 2014. His diverse experience includes building accounting organizations, ERP implementations, corporate restructuring, designing and implementing internal controls, and business process optimization. And last but not least, we have Dean Kwambo, partner of our business development practice. And Dean helps numerous private schools, social services, performing arts, fine arts, and faith-based organizations address their tax, audit, and outsourced accounting needs. His laser focus brings to life the accounting items that matter the most. All right, so what are we going to learn today? Well, we will start off by discussing why employee fraud occurs. Recognize the most common types of fraud, identify ways to prevent fraud in small nonprofits, and review the top control measures nonprofits should have in place. And here's the agenda. We'll first look at why does fraud happen, and within it, we'll look at the fraud triangle, type of fraud, audits, and then also talk about preventing fraud, tone from the top, about the board, top 10 control areas, and control measures to consider. All right, so with that, we're on to our first polling question. We want to know, has your organization implemented a formal fraud risk assessment policy? Is it A, yes, B, no, C, I'm not sure?
And again, let's everyone get your vote in. We know that CPE is a big deal. I know for me, my own license comes up for renewal in June, and I am scrambling for CPE hours. So we're going to give you guys as much time as possible to show your participation right here.
All right, we're going to close in a couple more seconds, so make sure to get your answers in. All right, we're going to close in 3, 2, 1. Here are the results. So 42% of people say no. What do our speakers think of that?
Well, it's definitely not best practice, but at least you know. What I'm really concerned about is the C, is the people who don't know and are maybe not sure. I think maybe that's something that we should, if you're on the line and you're not sure, that you want to look at. Really quickly, when you look at our Menino, we could just quickly do a brief overview. We do have over 1,000 people, and over 250 of our folks specialize in nonprofit. It's actually our second largest niche by revenue, and our largest niche with regards to client count, as we work with over 650 nonprofits across the country. We do work with our nonprofits in lots of different ways, whether it's regards to financial statement reporting and compliance, technology, and using best of breed software to increase productivity. And lastly, human capital, finding the right people and putting them in the right seats on the bus per se. On the lower ribbon, you see all the different areas within nonprofit that we work in: private education, foundation, social services, performing arts, animal, the environment, and religious orgs. And you can see some of our more well-known clients that you might recognize here, whether it's social service, again, animal welfare, faith-based organizations. We specialize in them all, and nonprofit is a big part of what we do here at our Menino. Okay, so why are we all here today, and why are you logged in? And let's face it, whether you're management of a nonprofit or you're a board member of a nonprofit, nobody wants to be in the news when a fraud at a nonprofit happens. You know, when I visit different nonprofits and I speak to their boards, I inevitably always get the poke on the shoulder. Hey, who are you? And I say, oh, I'm with the auditing firm, or I'm with the accounting firm, and we work with you. And inevitably, that board member always looks at me and says, is it all there? Is everything okay? Because nobody wants their name to be associated with a fraud or something that's happening. I mean, who wants to be, you know, this poor guy in the Davis enterprise? I went to UC Davis, and this guy's stealing from kids. That's not a good look. Another story is, unfortunately, the Oklahoma Beef Council. Here we had an employee, a quote unquote long-time trusted employee, who embezzled $2.8 million by forging checks from 2009 to 2016. She started a children's clothing boutique, and as the Oklahoma Beef Council said, she stole from 50,000 farmers and ranchers all over Oklahoma. So, you know, nobody wants to be in the news, and nobody wants to have to use that hashtag nonprofit fraud. So with that said, we're going to walk through today different measures that we can be doing on how we can prevent fraud, whether you're a large organization, and this is really tailored, I will say, this is tailored to the organization that's less than $5 million. But it is going to highlight a lot of best practices with regards to internal controls. All right, our second polling question.
All right, so we want to learn a little bit more about our attendees today. So this is to know about you. How concerned are you about fraud at your nonprofit? Is it A, very concerned, B, need help right now, or C, not so sure? What do you guys usually see when you're talking to nonprofits? Are people concerned about fraud a lot in nonprofit area?
I would say, depending on what's going on, you know, around them or that time of year, when it's front of mind, of course, and when it's not and people are busy, it's very low on the priority list.
Yeah, I mean, very concerned as long as it's not happening, right? I'm very concerned that it doesn't happen. And that's kind of the typical answer.
All right, so we're going to close the poll in 3, 2, 1. So we have 63% of people saying not so much.
And that actually doesn't surprise me, Sarah, because if you think about it, most people don't know that fraud is occurring. Most
Right.
times it's baked into your budget and you don't know, or you feel like you do have very good internal controls and very good segregation of duties, so you're not that concerned about it.
Absolutely. And I'll add just right off the bat, it's not always known what the true magnitude of fraud is throughout the country, throughout the world, but actually the studies show 5% of all revenues are lost to fraud across all organizations, across all sectors. So it's certainly out there, and we'll talk about a few examples of specific dollar amounts and different fraud schemes. So we'll jump right in here to why does fraud happen? And the goal here is I want to make sure you all understand the mindset of a fraudster and what they're thinking about. And once you understand that, of course, then we can take the necessary steps that Eric will touch on here in a little bit about how to protect your organization and safeguard your assets against these fraud schemes. I do want to start off by pointing out, if it's not apparent already from our agenda, what we're talking about today is what's called occupational fraud. There's a variety of different types of fraud, but this is occupational fraud, meaning it's fraud occurring in the workplace, typically by employees of some level, against their organization, against the assets or the resources of the organization. So I'll also point out throughout a couple of these points some stats from the Association of Certified Fraud Examiners, which is the ACFE, and they put together a report each year called the Report to the Nations, and is a study of all the frauds that they've analyzed and investigated. And so there's some great stats that we can learn from and give you some context as we talk about fraud schemes and the mindset of a fraudster. So what you're seeing here up on your screen is what's called the fraud triangle. Many of you have probably seen this before, or maybe heard of it. It's an age-tested, it's a proven concept developed back in the 40s or 50s by an academic who studied psychology and fraud and the connection between the two. It really lets us see the mindset of someone committing fraud. And these three elements that you see up here are prevalent in almost every single fraud case that has been investigated. And so it certainly stands true. So what I want to do is make sure you picture kind of in your mind, again, this mindset of a fraudster. And what's typically occurring is this is an individual within an organization, and they are almost always in a position of trust. And that's a crucial component to this. They have some amount of trust delegated to them. And what happens is this person either has or they perceive themselves as having a problem that they can't share. And most commonly, it's a financial problem. So they have a personal financial problem, potentially. They don't feel like they can share that problem. They look around their organization and the trust that they have within themselves, they find an opportunity. And that opportunity allows them to secretly solve that problem without anyone knowing about it. They can conceal the fact that they've solved that problem. And then the last piece of the puzzle is they rationalize, justify their actions as being just and okay to solve that problem. That's the circular fraud triangle. I personally like to think of it in a sequential order: pressure first, then they look for that opportunity, then they rationalize that act as being okay.
Yeah, you have to have the opportunity, right? And that pressure, sometimes we don't even understand it, right? As auditors, it could be something like, we didn't know that they had a gambling addiction. We didn't know that they had a sick grandchild or something like that you just don't know what that external pressure is, but all of a sudden they can rationalize it. And then when the opportunity is present, you got the perfect storm.
Absolutely. So those are some great examples of the types of pressure that can create that motivation or incentive. Financial distress is probably the most commonly thought of one, but as Dean mentioned, there can be family members who have medical needs. Addictive behaviors are common in this pressure. So gambling, overspending, substance abuse, all of those are commonly thought of. What's sometimes not thought of are other external pressures, so stakeholders of your organization. So think of a for-profit, the investors, in a nonprofit, it could be funders, it could be the board, it could be executive management who's creating pressure down to their employees to solve a particular problem that they have. The other element we've talked about is opportunity, and a little bit more on that opportunity. You'll hear a lot of this as we continue the webinar, but internal controls is the most common opportunity, a lack of internal controls. Where can controls fail so that someone can commit a fraud? It's It's actually responsible for over half of all frauds that are reported and investigated. Other opportunities that sometimes aren't thought of are a person's level within the organization. So are they an employee, or are they an executive or an owner? Interestingly enough, in those stats from the ACFE, if an owner or an executive individual commits a fraud, it's typically 10 times of greater magnitude than when an employee commits that fraud. Also, the tenure of that employee. Have they been around for multiple years, or are they relatively new? As you can imagine, the longer they're within the organization, the greater opportunity they've had to conceal their fraud or look for that opportunity. So when someone's been around for 5+ years, they've stolen twice as much in those cases investigated. And lastly, I want to mention, it's maybe common, a great polling question actually would be, are these people repeat offenders? Are these career criminals that are committing these frauds? And the answer is no. Over 90% of the time, these are first-time offenders. So they've incurred some significant pressure in their life, and they decide to go commit a fraud to solve that problem. And that's the first time they've ever been convicted of anything like that.
And, you know, they've, like you said earlier, they found the hole. They found something that, wow, okay, that went through the cracks and nobody noticed it. And that just always reminds me of the number one thing is that trust is not an internal control.
Absolutely.
I mean, in almost every nonprofit fraud, you will hear it was a trusted employee. And unfortunately, that's just not a best practice to use trust as an internal control.
Nope. You know, the last piece here we want to touch on is that rationalization. Again, to give you some thoughts into the mind of these fraudsters. What are they thinking about? How could they possibly rationalize these actions as just? But if you really think about the position they're in, sometimes they think of it as borrowing from the organization. They fully intend to repay it, and they've rationalized their act as a borrow from the organization. They may be disgruntled. They may be unhappy about promotions or other peers within the organization. They may think the organization doesn't need it as much as they do. If you're a large organization flush with cash and they have a significant need, they can justify that they need the funds more than your organization does. So all interesting things to think about as you put your mind in the shoes of a fraudster. And next, we'll get into some specific types of fraud to start really peeling back the layers here and understanding how these cases occur. So what you're seeing now are a couple types of fraud. There's a much longer list of this, but these are the three that we wanted to focus on for today. Some are the most common, and I'll speak to that. But first being fraudulent financial reporting. Sometimes not thought about as a fraud scheme. We often think about stealing or embezzlement, and we'll talk about that here in a minute. But fraudulent financial reporting is someone who, again, has that trust, that ability to record transactions or report on financial results of your organization. And they they intentionally misstate your financial statements. And the key here is their goal is to mislead somebody. Someone who's reading the financial statements and they want to mislead their interpretation of the results, or they're concealing something they've already done. So they've already committed a fraud. They need to cover it up and cover up the results of that in the financial statements. Fraudulent financial reporting is actually the least common type of fraud that's been studied, although it has the greatest magnitude of loss. So fraudulent financial reporting has a median loss of $800,000, although it only occurs about 10% of the time. Asset misappropriation, the most common one we probably think of, the classic embezzlement type of case. So this is stealing or misusing the organization's resources or assets. Asset misappropriation is by far the most common type of fraud that occurs over 90% of the time, but it's the least costly, about $100,000 median loss when those cases occur. And we'll talk more about asset misappropriation because that is the most common. We'll get into that here in a minute. And the last one we want to touch on is corruption. Can be layered in with all these other fraud schemes, but corruption is just misusing influence, and typically it's to generate personal gain, as all of these are. But corruption can be prevalent in all these different fraud schemes. Also somewhat common, not as common as asset misappropriation. So we'll get into that one specifically next. And here's where we get into maybe a little bit more of the fun stuff and talk about some examples, some specific fraud schemes to help you understand where this can occur before we talk about how to protect your organization. So asset misappropriation really has 9 different subcategories of fraud schemes. And we'll talk through each of these so that you understand the risks to your organization. And as you hear about them, think about how these might happen in your own organization. The first being skimming. This is skimming off the top, so to speak. It's taking an incoming payment to your organization before it's ever been recorded. So extremely hard to detect after it's occurred because nothing's ever been recorded. It's not on the books. No one knows it came in, but the fraudster has stolen from the organization before it ever touched the organization.
And I think the big thing to be aware of there is we all know that when someone is giving to a nonprofit, all they really care about is that acknowledgement letter, right, Mike? If they get the acknowledgement letter, they feel like, hey, that nonprofit did the right thing with that gift.
Right.
Okay. So that I think that's what the nonprofit should think about there, right? Is okay. Well, who has the control over that, right? If we can control cash coming in, number one, and then number two, can we control the acknowledgement letter?
Right. And skimming, unfortunately, this is the classic. You don't know what you don't know. You don't know how much you earned at that fundraising event or the parking fees or wherever it may be. If it's cash rich, it's might be understated if someone was skimming off the top because you don't know whatever was there in the first place. Cash larceny is the second type of scheme under asset misappropriation, slightly different than skimming. Cash larceny is stealing an incoming payment after it's been recorded, but before it's been deposited. So again, more common in a cash rich organization, collecting actual currency. You might record it, log it when it's been collected, but as you take it to the bank for deposit, someone is stealing some of those funds. So obviously the key here is logging it from the first, as soon as it enters the doors, making sure you've recorded all those transactions, but equally as important is after the fact, reconciling that log to what was actually deposited, because no sense in recording it if you don't compare it to what was actually deposited in the bank. The third scheme, billing. So this is essentially a fake bill. This is someone who has sent a bill to your organization. It might be from a fictitious entity or from a slightly different name from a common vendor of your organization. It's processed, it might be approved, it might be paid completely legitimately through your cash disbursement process, but the cash is going to an ill-intended individual or organization.
So vendor fraud.
Vendor fraud. Yep.
Ugh, painful. I had an organization that was asking for an audit. I talked to the CFO for about 3 years in a row, and I would give the audit proposal, and she'd say, "Okay, we're thinking about it." And then one year, I got a call from the board chair, and I said, "Oh, are you calling about the audit proposal that we have outstanding?" She said, "I don't know anything about that, but we do think that our business manager has been committing fraud, and we need your help." And it was, I think, $300,000 to $400,000. All vendor fraud.
Yep, and that can go on for quite a while. Those types of schemes can be long-lasting. Not as long-lasting as a payroll scheme. The next one we want to talk about. Payroll schemes are actually the longest duration fraud scheme that's been studied. They can last 24, 36 months before being detected. So a payroll scheme, this could be a ghost employee, someone who has that trust, that ability to monitor payroll, the system and the input of data, and they could put in a fictitious employee that is actually paying themselves or a related party to them. Also could be as simple as inflated overtime hours. So time card fraud is payroll fraud. Again, these can go on for quite a long time before being detected because they're just embedded in with your payroll transactions. And if there are not a lot of close eyes on that activity, it can be hard to see.
I know one that we saw here was an organization where their executive director, they had a hole in that position, or it was empty, vacant for I don't know, 12 to 18 months. And the top finance person said, "You know what? Well, I'm kind of doing the role of both CFO and COO and the executive director, so I'll just give myself a raise." And by the time that new person came on board, they just took their salary back down to where it was before.
Yep, that's something to think about too. As we talk about the trust of individuals, that can change. Right? If there's turnover within an organization, all of a sudden someone who didn't have that authority does, and they act on it immediately when they see that opportunity. Expense reimbursements. This is a relatively simple one that we're all probably familiar with, but expense reimbursement fraud, so fictitious documents, altered documents. This is the classic, double receipts for the same transaction, usually personal expenses in nature. Something else to keep in mind on this is personal credit cards. If the organization is reimbursing its employees for expenses related to the organization on their personal credit cards, of course, we need to see original receipts. Otherwise, it's hard to tell if that is accurate expense reimbursement or fictitious. Check tampering. This one is altering checks. So it may be an individual who has the authority to send out checks, and they alter names, dollar amounts before they're mailed out. This could also be intercepting outgoing payments. After they've been sent from the organization, someone intercepts that check in the mail or some other form and keeps it for themselves. Cash register disbursements, probably not too relevant for all of you. This is more on a cash-heavy point of sale type of retail transaction, fake entries in that point of sale system, usually to conceal cash that's already been skimmed or stolen from the register itself. Cash on hand, the most classic form of theft, just stealing cash. Petty cash, cash in a vault, any cash that the organization is holding that someone steals from the organization. And lastly, non-cash larceny. Last on the list here, because probably least thought of, this is theft of any non-cash assets. So think of equipment, inventory. Probably least thought of is data, employee data.
In today's day and age, that seems like, yeah, everything's okay. Let's make sure we know where all the iPads are and all the laptops and the digital cameras and all of that stuff. But then if you think about what could be most valuable,
Donor data, vendor data, employee data.
Ugh, that makes my stomach hurt.
That's right. So those are a variety of different schemes within asset misappropriation. Next, let's start diving into why does this happen at our nonprofits, particularly our small nonprofits. We talked about the schemes, but really what is it about these small nonprofits that make them susceptible to these various fraud schemes? First and foremost, sometimes this is at the tone of the top, which we'll talk more about this in a minute. Eric will touch on it, but management or board members may just be more trusting in nature. It might be related to the mission of the organization. It might be uninvolved boards that, again, they don't know what they don't know. What we encourage is an appropriate level of skepticism, a questioning mind for those board members to be encouraging management to talk about fraud risks, and asking those questions of where things could go wrong within their organization. Internal controls, we touched on this, we'll touch on it more, but the lack of internal controls at a small nonprofit creates a significant single point of failure or an opportunity for fraud. Segregation of duties we'll touch on, but that's a classic one for small nonprofits, simply a lack of available resources to segregate the duties to protect themselves from fraud schemes. And lastly, audits, a belief that the annual financial statement audit will cover it. Again, you can't rely on that financial statement audit, but sometimes there's a misconception on the goal of those audits, and the board or management may rely on that one time a year check-in to catch any potential fraud. So we want to touch on that a little bit. I'm an auditor. Dean's been an auditor. We conduct lots of financial statement audits each year, and we want to make sure our audience understands the true goal of those financial statement audits, which is not to detect or uncover fraud. There is an aspect of that within the standards that govern our work, but simply put, our audits are not designed to uncover fraud. They have a much greater scope. And so it's important that you all understand that, your board understands that, and that you have the responsibility to protect the organization from fraud, not the external financial statement auditors.
Yeah, the interesting thing is when we do the fraud inquiries as the part of the audit, you say, hey, unfortunately, in 3 years from now, your organization is going to be in the paper, and it's going to say, hey, huge fraud rocks XY organization. And your first reaction is going to be like, oh my gosh, no, that's terrible. Your second reaction is going to say, wow, where'd they do it? And then when you say, well, they did it in this area, if you as a nonprofit leader, were to take a step back and say, wow, okay, they did it there. You know what? Looking back on it, that might make some sense. That's an area that we didn't have the best controls over. We did have really good controls over our annual gala. We did have our best controls over, inventory or cash receipts or cash disbursements. But when you think about that one thing, we were really never that tight about it. Or we had one employee there who was just kind of all over it, and we just figured they had it all down. And then you say, oh man, that does make sense.
Yep. So also important to realize that There is opportunity to engage professionals for a specific fraud investigation when needed. If there is a suspicion or an allegation of fraudulent acts, you can engage within that Association of Certified Fraud Examiners. I mentioned are certified fraud examiners, CFEs, commonly also CPAs, and they can conduct a formal fraud investigation, which can then be used as evidence to prosecute that individual if ultimately a fraud did occur. But again, to really reiterate this, less than 10% of all frauds are discovered as the result of a financial statement audit, not because we're poor at what we do, but just because it's not designed for that function. And we're happy to share more about that if anyone has questions around the difference between a financial statement audit and a fraud investigation.
All right, so here's our polling question of this week. This is going to test you guys how well you were listening to what Mike and Dean were talking about. The question is, what are the most common types of fraud? A, fraudulent financial reporting. B, asset misappropriation. C, corruption. D, all of the above.
Well, you might have to give a hint here, Mike. That was a little, this is going to be tough.
And I want to remind our attendees today that
I'm on a webinar. Simon will be working with you first. Yeah. Okay. And Judy is in South Korea today.
One of those chances. And also, please keep sending your questions in. We are going to address all the questions at the end of the webinar, but we are seeing some come in, so keep doing that. All right, we're going to close the poll in 3, 2, 1.
Which look good. I know that the wording of the question was probably a little bit, could be confusing. Asset misappropriation, which the majority of you answered, is the most common type of fraud. Of course, all three are common types of fraud, so all the above sounds good as well. But again, asset misappropriation prevalent in over 90% of all frauds.
And I just want to remind our attendees, please keep your microphones muted because it creates a disturbance. So it will be really appreciated if you all just check your mute options.
Great, so now we're going to talk about preventing fraud. So fraud prevention starts at the top, and the top is the board. Your board is responsible for the financial stewardship of your organization, and the board should be active and engaged. They should communicate regularly with the organization, and they should keep this at the front of mind, not just growing the organizations, serving its constituents, but also keeping the assets safe so that they can further the organization's stated purpose. Best practice we feel is that at least one board member should not only have a passion for the organization, but also financial acuity. You need someone that is schooled and educated and experienced in reading financial statements and can provide value outside of just guiding the company, the organization. Also, it shouldn't be just the current management's favorite foursome from golf. They should have outside people that can provide an independent perspective that can be invaluable to an organization.
Yeah, we definitely believe in the top-down philosophy here. As much as the board is involved and they set the tone, I think it could set the policies and levels of review for the nonprofit.
Yeah, and I would even add, again, the tone outside of the board meetings themselves, right? Extending beyond the other board members and the executive members of management, but making it known that they have that skepticism I talked about. They want to hear answers to their questions. They want to know where the risks are, and that should trickle down through all the different employees in the relevant areas of the organization.
And Eric, you work with lots of nonprofit boards with regards to financial reporting and presenting monthly financial statements to those nonprofits. What are some of the best practices that you see there when you feel like, wow, this board is really involved, they're in tune, they're asking all the right questions? What are they looking for, and how can you just tell that they're a very involved board, setting that right tone?
That's a great question, Dean. What I like to see is a board that challenges the management team, and they don't just read the financials, but they ask probing questions, and they're really kind of testing to see if the management team not only knows the finances, but can understand and really has a firm grasp of the operations. And some of those good inquiries are, demanding explanations for income and expense variances from budget to actual and actual to trend. If we're growing or shrinking, why? Liquidity should always be in the front of mind. Cash is king, and the management team should be able to explain why or why not an organization has appropriate liquidity. They should be asking about any changes in the management team and how that affects the organization. And have there been any changes in the internal control environment? Are we getting stronger or weaker? Because nothing ever stays the same. What are the major drivers of current operations? And most importantly, I think this is Mike's favorite, what could go wrong? What do we need to know about that we don't know about yet?
Yeah, and I'll add to the changes in management team. It's an interesting one. As an auditor, when I go to those board meetings, the audit committee meetings, and if I know the CFO turned over during the year, the controller turned over during the year, and not a single board member asks us, the auditor, what did you do about that? What did you dig in on? That's surprising to us. Now, more times than not, they do ask that, which is great, but we like to see them involved, as Eric mentioned, asking those probing questions, looking to the auditors for how they can be connected between the audit process and their own internal assessment of their organization.
And it is amazing. We're talking about setting the tone. When a board member can ask a question, a probing question, it makes you feel like, oh, wow, somebody cares, right? It's very true. Oh, somebody cares. That's not just going to skate through under review and I won't get any questions.
Yep. No, I think the management team should always leave with homework, right? There's always those questions that they'll dig till they can't answer something and then commit to answering that in the next meeting. So
the meat of it, Eric.
The meat, here we go. So we've got 10 here. These will not ultimately prevent all fraud, right? But what they will do is reduce the opportunity. You may have employees that feel pressure. They may have rationalized, but if they don't feel that there's an opportunity, they won't commit fraud, or they'll be much less likely to. So if you do implement these, and we strongly suggest you do, be very vocal about it. Don't try to do it subtly and catch somebody. What you want to do is prevent the fraud, because it's great to catch fraud, but if everyone knows that you're actively seeking out fraud, you're going to be much less likely to commit it.
And Eric, it's not even just, when it comes down to prevention, if there was that fraud at your nonprofit, really everybody on the line and everybody listening, they should want to be like, well, it wasn't me. Well, why is it not you? Well, because there's all these controls around me that I couldn't commit a fraud. And that's really what we're looking for. We don't think anybody on the line is going to commit fraud, but we are looking for protections from you and your role.
Right. And it's a numbers game. The IRS reported that over the last 7 years, over 1,100 small not-for-profits reported fraud in their 990. And that number, I feel, is very understated, because it only included the 990s that were filed electronically, and it only included those where they actually owned up to it, right? There can be fraud that they found and handled discreetly, because everyone's scared that if they have bad press regarding fraud, it's going to affect their funding, it's going to affect their operations, and nobody wants that stigma. So let's jump in. All right, number one, double signatures and authorizations. So we want to force people to need collusion to steal, and a great way of doing that is by requiring more than one signature on a check. So for every expenditure you have over a predetermined amount, you should have 2 signatures on that. So I highly suggest you look at your disbursements for the past year. You'll find that 20% of your disbursements make up about 80% of your expenditures. So that dollar amount, whatever that line is, should be the threshold where you start requiring 2 signatures. If you don't have the bandwidth to do that, consider having an officer or a director be that second signature. It keeps the board involved, and it makes it even more visible for the people that may consider stealing.
Eric, I like what you said there. Use your resources. There's lots of people that are involved in a nonprofit, and use them all. One of the things to be aware of here in double signatures that we've seen in our past, Mike, is that say that threshold is okay, everything above $5,000 is going to be duly endorsed. Well, boy, I would be looking at a lot of checks in that $4,000 range. I just pay attention to what's going on under the threshold, right under the threshold.
Yep. And be aware, as I know many of you are, the banks aren't your friend with enforcing this.
It's cheaper to pay you back than it is to enforce this, right, Mike?
Checks go unsigned.
Oh, absolutely. So backup. Always have your documentation. So when you are going through your check signing process, you should have a standard invoice package that has the check, the original invoice, not a copy, any support, the approval for that invoice, so that the person reviewing it has a single place to look. And then as you go back, that you've got a good audit trail. And also anyone that may be thinking about some funny business knows that there's going to be an adequate review with adequate documentation. We can't stress enough to do monthly bank reconciliations, and again, make it visible. If people in your organization know that you're looking at your finances on a monthly basis, they're going to be much less likely to try to take from you than they are if you're looking at it quarterly and especially annually.
And I know this probably sounds relatively simple. Keep your backup documentation. But again, for nonprofits under 5 million, they're trying to make payroll, trying to cut, key vendor checks.
There's just a lot of things going on, and it's something that I think a lot of people go, oh, it's fine, until that fraud is now baked into your budget. Now it's not fine.
Right.
This one we see all the time. Number 3, oh, I'm going on vacation. What are we going to do?
We're going to pre-sign checks. Don't do it. So it's a resource constraint issue, right? You just don't have enough people. So we highly recommend having someone else sign those checks for you, delegate that authority. It's great to get another person involved in the process. If you can't do that, just wait till they get back. But please don't do that. And also, even when people aren't on vacation, keep the checks and the signature stamps locked up.
Yeah, that's always a good question. I mean, who has access? That's just easy blocking and tackling questions here. Okay, who has access to the check stock? Who has access to the signature stamp? Who can print it off? Those are all just, is it all the same person?
It shouldn't be. And that's why you should have the segregation of duties. So I think Mike talked about this with the skimming. One person should not be responsible for receiving, depositing, recording the entire cash receipt process. Have a second person involved. Again, forced collusion. Money going out is maybe even easier to steal. Don't have one person responsible for the entire disbursement process, reconciling bank statement. It just creates a massive opportunity. There was a story in the news last year, I think, about a woman that stole $3.7 million. And she did this just by changing the name on a vendor from Brookings Institution to Brookings Institute. So they sent a lot of money to that vendor, and then no one noticed that it was a different one. And over 5 years, she stole $3.7 million.
Ouch.
It was in the budget after the first year.
And I would say here, you could always do the restrictive endorsement on any cash receipts for money coming in. You could stamp that for deposit only, and have that person just so we know that where that check is going to be deposited. And then with regards to money going out, I would highly encourage everyone for all the little different events that happen at nonprofits to keep a P&L for that, and to track both the gross income and gross expenses for that event. How many times do we see net reporting, Mike? And what are the is there some problems with that?
Oh yeah, just lack of transparency is tough to see where it's going. The key thing here with the segregation of duties, and I'm seeing some questions come in about it, and I don't blame you. Again, we're talking about nonprofits, small nonprofits under 5 million. This is probably the most challenging control measure, segregation of duties. You have one person in your accounting team. How are you going to segregate all these activities? And we get it. We see it a lot. I would encourage you we'll talk about prioritizing these control measures here at the end, but maybe this is one that you just have to live with. But it's a preventative control. And so if you can't prevent fraud by segregation of duties, You hopefully can implement a lot of detective controls after the fact to keep a lot of eyes on the activity, the financial reporting, the logs, who's reconciling, to make sure you can see if a fraud does start to occur and stop it.
Right. So what I like there, Mike, is surprise procedures by that ultimate responsibility. So whether it's the executive director or the head of school or the pastor or the principal or whomever, they can always they should be at any time be able to go up to the accountant and say, hey, you know what? If they're not doing it all the time, say, hey, I want to see our vendor log. And I want to see all the disbursements year to date for all of our vendors. Oh, I want to see all of and we'll walk through more of these. But think about surprise procedures that you can do and take a look. Money going out. Like, why do we have, what was that place called? Brookings Institute? And then Brookings Institution. If they were to look at a vendor year to date disbursement report, they'd say, wow, we're paying 2 different Brookings? Why is that?
Well, they didn't do one for 5 years, Dean.
Yeah, there you go.
All right, let's move on. So credit cards, another don't do it. Have your employees use their own credit cards only for reimbursements related to the organization. Require the original receipt. Please do not pay off the statement. Do not have a person's admin or assistant create the expense report and have them approve it. It needs to be approved by a level up. And there needs to be a documentation of the reason the expense was incurred. And then just ask them questions. Even if you know the answer, you should ask the question so that they know that people are paying close attention to this, because there can be a lot of volume here. We saw a COO that over 18 months stole $108,000 using a company credit card. First couple were small, and then it just got bigger and bigger and bigger until they caught him.
Again,
108,000.
Again, once that individual figures out what that threshold is, items will be you'll be amazed that, oh, wow, anything under $300 they're not looking at. And all of a sudden, those $300 transactions start flying through. So definitely something to look at there. Asking questions about those reimbursements is always a good thing, and checking on it. Again, pay off the original receipt for sure. Again, and also another common finding is, the executive director has the CFO approve the credit card reimbursement report for them, and that just doesn't work because that CFO reports directly to them. We say, hey, should a board member look at it? Should an audit committee member look at it? Should a finance committee, somebody else, get one other person involved? And even if they have to do it, hey, we understand lots of volunteers here. They don't have to do it monthly, but should they look at it quarterly? Things of that nature.
Well, and if there's a standard process, right, you can make that digital, send it to them. It's an easy review. It can be done via email. And then
we love it.
They know someone else is looking at it.
Yep, use technology for sure.
So I would imagine most organizations are doing this, but contract bidding process is very important. And again, I would recommend following the 80-20 rule. Resources are constrained here, but your largest 20% probably eats up 80% of your expenses, and those should go through a bidding process. At least 3 bids. It's great to approve a manager that's not involved in the transaction, and exceptionally large contracts should be looked at and voted on by the board.
Yeah, I mean, let's be real here. We all know that relationships are key, especially if, large organizations, small organizations, we all have relationships, right? We all have the guy down the street who runs an organization that wants the work. But let's just make sure that everything is above board and gone through the right process. We don't want to kick back opportunity here.
Well, and if your vendors know that there is a bidding process, they're going to sharpen their pencils. So even if you're not preventing fraud and getting a better price.
Win-win.
All right, so now we're going to look at the people involved. And, I did some research on this, and the CFE said that the majority of individuals that commit fraud and not-for-profits, they have a type, and that is a woman that is 41 years old, married with children, and she steals an average of $160,000. Men are approximately the same age, also married with children, and they steal about $350,000 before they're caught. And the problem here is that they don't wear name tags, right? They look just like the person in the mirror, So we need to have some human controls here. And two great ways of doing that are forcing employee time off and reviewing your payroll on a regular basis. Anyone involved in the financial duties of your organization should take regular time off, and their processes should be performed by someone else while they're out. If someone is not taking time off or is really reluctant to, that should be a red flag for you, and you should dig into the heart of that. Payroll reviews are very important. At least quarterly, review the payroll register against your active employee list. One client we helped out, their payroll costs were high, so we did a quick review of this, and we got creative. We looked at the bank accounts and the direct deposits, and we saw the same bank account, not just the routing number, but the bank account 11 times. And what happened, we saw, was that as people left, the person responsible for payroll would deactivate the employee record and then change the direct deposit information to her husband's bank account. So these people were paid for years before they were found, and they didn't see anything in the payroll person's bank account. It was in the husband's. Without looking at the direct deposit, we probably wouldn't have found it.
Yeah, and I would say there's just a couple things you could do here. Year-to-date payroll register, look for names, any names you don't recognize. We all know that lots of nonprofits have lots of contractors or part-time employees walking around. And it just doesn't hurt to just take a look at that year-to-date payroll register and do it if you want to. Do it on a surprise basis. Just say, hey, I want to see it. Pull it.
Great, we're coming up against the time, so I'm going to go fast now. You need to look at your financials and reconcile and track your profitability. If it's changing, you need to understand why. Again, reconcile that bank statement monthly. Dean, I think you touched on this, but don't net your revenue and expenses in one line. It's great for reporting, but it's great for fraud opportunities as well.
Yeah, it's always interesting that, we expect that event to always do 20 grand, and it always comes in at about 20 grand. Even if everybody says, wow, this year felt good, there was a lot of people there, still comes in at 20 grand. So definitely track all the profitability.
So the last one is almost free. You can empower your entire organization by having a whistleblower policy. So that policy should let the employees know that they can blow the whistle in confidence without retaliation, and that any reports will be taken seriously by the board. We recommend the audit committee being responsible for this. You should share that policy on an annual basis. There are lots of opportunities for very cost-effective fraud hotlines. Lots of organizations do that. And this is a way to get every person in your organization empowered and on board with fraud prevention.
And as Eric mentioned, this is just easy. And you'd be surprised the number of organizations that don't have an active whistleblower policy or tested communication process. That's another key point to this. Test it periodically, make sure it works, make sure whether it's an online-based system, which various service providers can set up for you, or if it's literally a phone call or email method.
Great.
All right, this is our last polling question, so make sure to answer this one if you've missed any. And here it is. Which of our 10 control measures do you feel is most important at your nonprofit? Is it A, double signatures and authorizations, B, payroll reviews, C, whistleblowers hotline, D, segregation of duties, or E, not sure? Again, this might be your last chance to get CPE credit if you missed any one of the previous questions. All right, we're going to close the poll in 3, 2, 1. And the answer, popular answer, was D, segregation of duties, with 65%.
No surprise.
All right.
And what I would just say on that is, obviously we have a lot of nonprofits that have the single point of failure. They have one person involved. And what we would say is, what can we do to include one more person in their processes? Right, Mike? How can we say, hey, what kind of monthly report can we add to our reporting package to get a couple more people involved to give that detective measure? Right. Yep. If you can't do the preventive measure because you are a single point of failure, one person shop, then what can we do from a reporting and review standard to help with that?
Don't just chalk it up as we're too small, we can't segregate duties. Oh well, do something about it. Put in some detective measures. Talk about it at the board level. Brainstorm. There's plenty of different things as we've touched on.
Is there any so with regards to control prioritization, we do talk about a lot of things. We'd say that, hey, focus on the area of that you feel that your nonprofit might be most vulnerable to, right? If there's, again, what we always say as accountants and auditors is this: if you're looking at something every single day or every single week, the likelihood that that's going to be wrong, not very high. But again, if you don't have much insight into it, if somebody else really controls that process, if you do it maybe once a year, then that area has higher risk. And I would take a look at that. And so maybe that's an area where you can prioritize. We do have a couple minutes left, and it looks like there was a lot of questions that came in. So we're not going to be able to answer all the questions. We will go through here and contact you all individually and get you your answers. But guys, is there anything, any questions that have come in that we want to address right now?
Yeah, I know one that we saw a couple of questions around. This is all great with documentation, but we live in the digital world. This is the digital age. Things are scanned. Things are housed in the cloud. We can certainly chat a little bit about how that works. I know Eric's service or his practice revolves around the cloud as well, and documentation held electronically.
Yeah, the outsourced finance and accounting is almost entirely cloud-based. And I would say that's really a step up from paper documentation. Paper documentation is susceptible to water, to fire, to age. If you've ever looked at a credit card receipt that's over a year old, good luck reading that. It's printed on the cheapest paper possible. So have a good cloud-based policy. Your cloud provider should have a co-location. They should be able to tell you how often it's backed up. The IRS, not necessarily the ruler here, but they've said for for-profit companies, as long as there's a legible facsimile of the original, it's completely adequate. I love it for my clients because when the auditors come in, I can just give them access to their records in the cloud, and they can trace and vouch to their heart's content. So, hope that answers the question.
And realize in some accounting systems or web-based systems where individuals are clicking through approval process, the workflow is done electronically. Realize that can always be downloaded. Transactional data of who made the click, when they logged in, it's all there. Might take a couple phone calls to your service provider, but you can get that if you wanted to do that control periodically to check who was performing those reviews.
Well, I think from your perspective, seeing the electronic approval is a lot easier than trying to decipher a signature or initials on a payment voucher.
Yep. Another one I saw that I think is a fantastic question that all three of us have run across over the years. Nonprofits, let's face it, especially of those of below 5 million, have a lot of volunteers. And some of their volunteers of different chapters might be doing the books. They might be involved in some of these key financial duties. How do you emphasize and how do you enforce upon fraud risks and prevention with a volunteer-based community? Certainly a challenge, right? And we understand that. I know from my perspective, just getting it out there and talking about it is probably the most important. Making sure they realize the risks to the organization that they're volunteer for. You might be surprised that a lot of this information we talked about in 60 minutes, they've never heard of.
Yeah, absolutely. Just communicating and getting it all out there is already a win.
All right. Thank you to our presenters for coming here today and educating us on these financial controls. And again, I want to remind everyone, we will be sending out the deck and a recording of this webinar in 42 hours. So you all will have a copy. And yes, and we will answer any missed questions in the email as well. So thank you for your questions and thank you for your time.
Thank you, everyone.